I'll use it. Okay. So student loan interest, there is a phase out period, and it's a little hard to see here, but there's a phase out period when whenever something is, a lot of times you'll see this in taxes. A lot of times you'll see that there'll be a phase out period for something. So if there's some benefit that they get at some point in time, you're making so much money, they say, okay, you don't need this benefit, basically. For instance, student loan interest. If you're making a tremendous amount of money, they say, okay, you don't need to have to write this off. This is really for people who have got a lot of interest and they're struggling, or they're, at least it's more difficult for them to pay taxes because of this. We want them to get the education, but and at some point they phase it out. And then there's a lot of things in taxes that get phased out. And the phase out, the way you do phase out, phasing out of it is the same. So we're going to do the phase out for student loan interest, but there's other things that phase out the same way. There's dividend phase outs and all kinds of other stuff that phase out basically the same method. So let me put the camera back. Okay. So the student loan interest, maximum allowed is $2,500. We knew that from last class and a couple weeks ago. Now, there is something called the modified adjusted gross income calculations, which I don't think we talked about, at least not very much. And that is, the modified adjusted gross income calculations are basically there to kind of put you back on a level plane with other people. So these are things that you get to deduct for your adjusted gross income, but basically you add those back in when you get your modified. So you'll take your adjusted gross income and then any of these things add back in. And the one that's obvious for us is going to be student loan interest. That's what we're talking about writing off. So that will definitely get added back in. Okay, and there's some other things here, but we'll focus on the student loan interest. Okay, now here's the phase out periods. So if you're single, head of household, qualifying widow, those are the phase out periods. They should be spaced over. If you're married filing jointly, it goes from 140,000 to 170,000. If you're married filing separately, you don't have to worry about this because you can't write off the interest anyways. Okay. So we're going to kind of see how this all plays out. And the first one we're going to do is Amy, down at the bottom. Okay, so Amy down at the bottom. Again, I apologize for the spacing. I'm not sure what happened there. Okay, so Amy has adjusted gross income of 75,000. She pays student loan interest of 1,000. She's a single taxpayer. And her only adjustment for modified gross income is her student loan interest. Okay, so student loan interest is the only thing that she has that would change her adjusted gross interest to, excuse me, adjusted gross income to her modified adjusted. So the only thing here that she has is this one. We're doing this time maybe. So we have our adjusted gross income. And by the way, you'll see this as AGI all the time. The taxi people, that's all they use is AGI. That's what they usually say. Okay, so coming down here, so her modified adjusted gross income. We start out with her AGI, adjusted gross income. And we go to her student loan interest, it's $1,000. At least initially, she can do all of it because it's below the $2,500 maximum. Okay, so this will be modified. Oops, forgot ID. $76,000. Okay, now you'll notice something. She is in the middle of the phase out period. 76,000 lies between 70,000 and 85. If it's less than 70,000, she can write off the whole 1,000. If it's more than 85,000, she can't write off any of it. All right, so so going this way, it's 100%. Going this way, it's 0%. You can't write off any of it. So between the 70 and the 85, is going to phase out linearly from there. So how much she can actually deduct. So the question is, how much can she deduct of 1,000? So it's kind of like this. I hope this doesn't become more confusing. But here's 70,000, here's 85,000. And so here is where Amy's income is. Now, the closer you go up to the 85,000, the less you can deduct. So there's actually two ways we could look at this. We could look at it from how much can't you deduct. So that would be this first part here. Or how much can you deduct would be the second part when we look at the ratio. So I think probably the easiest is to go through the first part. Now you'll notice that this span here is 15,000. So 70 to 85 says 15,000. And Amy is 6,000 into that. So of the 15,000, 6,000 of it, 16 of the 15,000, 6,000 of the ratio there she cannot deduct. So I'm going to do the calculations on here. So this is the not allowed interest. Okay, is the extra 6,000 she is in from here. Divided by the total, which is 15,000. Times the $1,000 interest. All right, so reiterate that. Some markers. I'll do it with yellow. Okay, so she's 6,000 into the lowest level here. 6,000 into it, so that's where that came from. The 15,000 came from there. So we're going to divide those, 6,000 divided by that, and then multiply by 1,000. And this is how much interest is not allowed. All right, 6,000 divided by 15,000. Oops. 4 times 1,000. So 4,000 of it is not allowed. So how much can she deduct? Let's see. So she's not allowed 400 of it. And you'll notice as that goes up, by the time you get to 85,000, well, 100% of it's not going to be allowed, right? So as the higher this goes up, the more is not going to be allowed. So she's allowed interest of $600. So when she goes back and recalculates her AGI, she's going to use, instead of 1,000, she's going to use 600. Any question on that? Okay, so this is kind of a phase out period. Oh, wrong pen. So here's the two limits, and there's where it goes up to. So as this goes up higher and higher, more and more is not going to be allowed. And again, there's other things that do the phase out also. It's a fairly common thing. They generally don't take it away from you all at once. They do it gradually if they're going to take some benefit. Now this one's messed up too. Okay, Fred and Wilma have just gross income of 158,500. Fred pays student interest of 2,000 and Wilma pays student interest of 2,800. Fred and Wilma file their taxes, married filing jointly, and this one, okay. So first thing, let's look at this interest. This is one of the strange parts of tax law in that the 2,500 is on each return. So Fred and Wilma don't each get 2,500. The entire return can only have 2,500. So if you're, filing singly, it's 2,500. If you're filing jointly, it's 2,500, and so forth. So 2,500 is the max. So they can't go 4,800. So the most they can go is 2,500. So that would be the most that they could take off with their adjusted gross income. This is the max, and again, and that's even for married people. Usually the married people, they get but get two people, then they double it. But that's not the case for student loan interest. Student loan interest is 2,500, and that's it. Or single, or jointly, or head of household, or whatever. Excuse me. Okay. Let's do the. I'm going to abbreviate. No, I want the first one. So modified adjusted gross income. We start out with, remember from back here, adjusted gross income. We're going to add that back in student loan interest. When you're doing this calculation, you would always have this. It's possibly have these other things in there too, but this one you definitely have in there. The student loan interest is 2,500. And so this would be your what is it, 161,000. Okay, now kind of the phase out of this. If I just gross income is, it goes from the poorly spaced 140,000 to 170,000. Now they fall at 161,000. Okay. The span here is, now you'll notice that the, even though the 2500 is the same, the actual phase out, all the numbers from the single are double. 2 times 70 is 140, 2 times 85,000 is 170. So this goes up. So this span here is 30,000. And the question is, well, if they go all the way up to the top here, they're not going to get anything. So the question is, well, how far do they have to go up? So far they've gone from 140 up to 161. So that's 21,000. So when we do our ratio, that's what's going to be not allowed. So non-investment loan interest is going to be our 21,000. And that's going to be times 2,500. And again, that's the max. They paid more than that in interest, but the max they get is 2,500. So how much of that 2,500 do they get? Can they not write off, basically? Okay. $1,000 divided by 30,000. So that tells us how far into it they're in. So it's 0.7 times 2,500. So this is the amount that is not allowed. Okay, so it's 750. So this would be the allowed student interest. By the way, just you guys probably picked up on this already. If 21,000 is not allowed, another way you could calculate it and say, well, what is allowed? It would be the other 9,000. So 9,000 divided by 30,000 times that would give you the 750. There's more than one way to calculate that. But basically, it phases out. It says, okay, as you go up, we take away some of the interest that you can deduct. Until if you get all the way up to 170,000, you can't deduct any of it. So how much can you not deduct? And so this keeps going up and up and up until you can't deduct any of it after 170,000. Okay, poorly spaced example number 3. Kind of an easy one, and that is 2-year modified adjusted gross income. Sandra has AGI of 91,000 plus her student loan interest. 4,100. Oops, 4,100, but you can't do all that. 2,500 is the max. Doesn't really matter because she's at 93,500 for. And you'll notice that on here, she's a single taxpayer. She's over the 85,000. She can't deduct any. How much can she deduct? 0. Wrong pen. Put you away somewhere. So okay. Oops, that's just like a 6. It's 0. She can't do any of it. She's too much income. Over 85. Yeah, over 85,000. Okay, so that's the student loan income. That's a phase out. And again, there's other things that phase out, but they all do it basically the same. It's how far do you go in before you phase out completely. Once they go past the phase out, then it gets real easy because they just don't get it. Okay, let's go to chapter 5. Oh, I gotta give you. I'll send out a test today for this one. It won't be due till next week. I don't think it just hit me. I don't think I put the grades in. I'll get the grades in. I don't think I put them in. All right, I'll get the grades in for you guys. Apologize. And I don't think any of you guys are missing anything. Really nothing big. Let me check to make sure because if I'm missing anything, I'll send you guys all that an email. But I don't think you guys are. I think you guys are. I'm teaching 2 other classes, and you guys are by far the most reliable. You get all your stuff. Yeah, let's say everybody has pretty much everything in. I see how to put the grades in. Okay. The unfortunate thing about that is when you have a class that doesn't, everyone's doing everything right, you kind of don't do what you should and put the grades in. Okay. So we're going to start on chapter 5, and just to kind of give you kind of a background on chapter 5, it's that we have our standard deductions, and that's what most people take. And you remember that it's single, it's 12,200, and if it's married jointly, it's 24,400. I forget what the head of household, I think was 18 something, 18.3. I'll look it up. Anyway, but so these are the standard deductions. Now, they can do the standard deductions or they can itemize. And itemizing deductions used to be very popular. They were a real pain in the butt, but they're really popular. And that was because the standard deductions were fairly low. And so the itemized deductions allow you to itemize a lot of the things that you have expenses for that are allowed. And for many people, the itemized deduction would be a larger than the standard. It's a little more difficult to do now. I mean, for instance, I think the standard deduction a couple of years ago was something like for married filing jointly was I think like 11,000 or something. I can't remember what, but it was way less than it is now. They moved up these standard deductions to a higher rate, and more people, even if they have some itemized deductions, it's you're better off taking the standard. One of the humorous things that comes out though, sometimes people, they keep all their receipts and all that stuff, and they want to do the itemized deductions, and it's a lot of times it comes up to be much less than this. And I did taxes for my mother-in-law, and she was kind of in there. She said, well, we have these expenses of, yeah, it's $13,000. This is what you get. Did you read the right 13,000 off or 24,000 off? So anyway, so this is kind of what Chapter 5 is getting into. Now, there are some people that itemized deductions are more favorable. So it isn't that everybody should be doing these. If you have a lot of things, expenses, it's possible that you have itemizing can be the way to go. And today we're going to concentrate on the first one, which is can be a huge one for people, and that is the medical. Okay. So let's go to the chapter. It's a little bit better. A little fuzzy on the corners, but we're getting there. Okay. The first one is medical expenses. Now, as you can imagine, medical expenses can be absolutely huge. So this is one of those things that a lot of times if you have someone who has a lot of medical expenses, this may be the thing that tips them over to go to the itemized deduction, because as you know, going to the hospital can easily cost $40,000, $50,000 or whatever it is. And if you don't have insurance and you're paying out of pocket or whatever it is, that it's very possible that medical expenses are going to be the thing that really makes it advantageous for you to itemize. So the first thing we're going to talk about are the medical expenses. Okay. What can you deduct for medical expenses? Basically anything that is necessary. And so any of the costs for the diagnosis, cure, mitigation, treatment, blah, blah, blah. For the most part, medical deductions are fairly straightforward. There's not usually strange ones in there, not too many anyways. Transportation and lodging. So if you go to the doctor and the doctor's 100 miles away, you can deduct it. You can deduct it 1 mile away, but you can deduct for the transportation of going to and from a medical, a medical case arising. So transportation and lodging are, well, there's some limitations on the lodging, actually on the transportation too, but anyway, qualified long-term care services. So somebody who goes into long-term care, both my parents had Alzheimer's, so we had to have them in a care unit that was on lockdown, which is very expensive. You could also go wandering off, and so it was very expensive. But anyway, the long-term care can be written off, and the insurance for the care. So if you're paying insurance, if you're paying it out of your pocket, it's not reimbursed. You're paying it out of your pocket. The insurance itself is allowed. So if you're paying insurance premiums of whatever, $800 a month, that $800 a month premium is maybe deducted. Okay, So here's the kind of formula. By the way, the book kind of shows us in a funny way. So I kind of put it in a little bit different format in the book. But if you're wondering, I think this one's a little more easy to use. except that they don't line up. Other than that, they don't line up. Yeah, sorry about that. These should all be over. Okay, so you get your allowable medical expenses. Insurance reimbursements, this should actually say really any reimbursement that you have. But insurance reimbursements, what is reimbursed to you for the payment. So these are the expenses. This is what someone else paid. So this would be what you paid down here. Now, this is one of those things that is a little bit, you ask, well, why is it like that? Minus 7.5 of your adjusted gross income. So the 7.5, this is, why is this in there? It's in there because they say, look, everybody has some medical expenses. Right? So the 7.5 is you can only deduct your medical expenses if you have, relatively more than other people. So they say that, they have to be over 7.5 of your adjusted gross income before you can deduct them. So for some people, this could be very high. This is, if you have a $100,000 income and 7.5 is $7,500. So if you have a $5,000 payment, you're not going to be able to deduct any of it. So minus 7.5% of the adjusted gross income. And that'll give you your deductible medical expenses. Okay. So let's go down here and take a look at and give this taxpayer a name. Okay, so let's come down here. So the allowable medical expenses the taxpayer had was $130,000. This would include insurance payments. So the insurance premiums would be in here, the allowable expenses. All right. It's not even even the way it's misaligned isn't uniform. Okay, 130,000. Now the insurance picked up 105,000. So the then allowable medical expenses would be the difference between those two. This is what the taxpayer would have paid out of pocket. So when they talk about out of pocket, this is what they're talking about. How much did you actually pay? And somebody will think, well, I paid 130,000. Like, well, no, you didn't. The insurance, picked that up. Well, it was insurance I paid for it. Yeah, but you paid for the insurance. It's in here, and so they paid that. So this is your out of pocket, what you actually paid out. So 7.5 of adjusted gross income. Okay, so whoever this person is, they had 80,000 times 7.5. And if you have a good calculator, you can put this in. If you have one of these, you move the decimal place over 2, so this equals 0.075. Oh, I do have a percentage key on here. I didn't need to do that extra. Okay, 80,000 times 0.075, 6,000. Okay. So should they itemize their deductions? Or use a standard deduction? So this would be the itemized deduction. The standard deduction is so this is the one they'd want to take. You'd want to, for this person, you'd want to itemize the deductions. You know, they get to take off 21,000 rather than 12,200. And again, usually this is for people that have very high medical expenses, which is not that uncommon. Someone has cancer, someone has whatever, you know, that it could be very high. I mean, surgery or whatever, these can be very high costs. So medical expenses are one of those things that if they have a bunch of them, it could certainly flow into this. As you get, you know, as you get people that get older, as they get a Medicare, Medicaid, and all that, a lot of times their actual amounts that they actually pay out, it becomes less and less. So even though, you know, a lot of times these are for people that actually have things that have gone wrong, you know, cancer, car accidents, and, you know, surgeries and all that kind of stuff, usually. Okay. This whole thing is spaced wrong. I'm gonna figure out what did that. I didn't use a crazy font. There we go. Anyway, okay, that's my complaining. Okay, dependent medical expenses. If you have dependents, their medical expenses also can be itemized. So if you have a child, especially if a child has something like cancer or something like that, you know, these medical expenses can be quite high, and you can take the expense if you are if you're paying, you know, for a dependent. Okay, a dependent child in a divorce case. The parent who pays medical expenses can deduct the expenses. So it doesn't go by who has custody of the child. Whoever pays for the expenses is the one that writes it off. So maybe it's a health insurance policy or whatever. That whoever pays that writes that off on their taxes. It isn't, you know, they may not have custody of the child, but if they're paying for the insurance, they write it off. So whoever pays it writes it off. As far as the dependents are concerned, the gross income and joint return tests do not apply. So, you know, if someone can pick them up on a joint return, but you're still paying for their, actually, the same as up here. If someone else can claim them, you know, that or have a joint return with them, it doesn't matter if you're paying the insurance on them or paying the medical bills, they still count. They still have to satisfy the relationship, citizenship, and support test. So you still have to be supporting them. They still have to be citizens, and they still have to have that relationship, which is basically one person out for everything except the grandchildren from the person. So yeah, you know, uncles are okay, cousins are not. Okay, cosmetic surgery. Generally speaking, normal, what you think of as cosmetic surgery, somebody gets cosmetic surgery to make their eyes look better or, you know, fix their nose or whatever it is. Those are not covered. But if it was for a deformity, you know, congenital means, you know, if you were born with something like a deformity, a cleft palate or something like that, it's necessary. If you have an injury, you know, if it's related to an accident or something like that, or if you have a disfiguring disease, you have some kind of skin condition that, you know, causes something to happen, whatever it is possible that cosmetic surgery is covered. One of the things is breast cancer, you know, breast reconstruction, all that kind of stuff. That's covered because it's related to the breast cancer. So cosmetic surgery is, you know, if it's just to make you look better, that doesn't count. But if it's for a medical condition, then it is. Then it does count. Okay. Example. So Mary sustains a head injury in a jet ski accident. Because of the accident, she has plastic surgery performed to reconstruct her face at a cost of $40,000. Is plastic surgery an allowable medical expense? Yes. It's related to the accident. She's not just having her face redone for no reason, you know, to make her look great. She was in an accident and it's related to that accident. If there was no accident and she paid, you know, that plastic surgery for $40,000, then no, it wouldn't be. Okay, reimbursed medical expenses. If you are reimbursed for the medical expenses, you cannot deduct. So if you have an employer that pays for your medical insurance, that generally comes off of your income anyways. But if it's paid by somebody else, you can't write it off. They can write it off, but you can't. So medical expenses are not deductible if they've been compensated by insurance or like. So if somebody has paid it on your behalf, then it's not deductible. Only the out-of-pocket is where you can deduct. So, and again, sometimes you get people that, you know, say, well, I paid, you know, $7,000 in insurance premiums. So, you know, it's like, well, yeah, but that came off your income already. And besides that, the employer, you know, basically paid it. So, you know, you weren't taxed on it and it was a benefit and somebody else paid it. So be happy. All right. Food generally does not qualify as a medical expense, even if it's prescribed by a licensed physician. Mark's doctor tells him to eat healthier. Doctor prescribes a low-calorie diet for Mark. Can Mark deduct the cost of the terrible tasting low-calorie food? No. It's possible that you could, if there was a really special case that the prescribed food had a different, an increase in price over the other food, it'd be very hard to prove that. But you would have to do that basically. But it could be, it's possible that it could be, yes. And that's, but very special cases. Generally speaking, if it's just a diet change, something like that, no. I do know a case of there was a special food that was made for people that have really sensitive systems, and only one company made it, and it was, you know, very expensive, but it was the only thing that certain people could eat, and it was the way it was made was special. It only, you know, and so that would be a yes, because it was very expensive and there was no substitute for it. Okay. Alterations to property. If I drop it a little bit, it gets better. Okay. Alternative pricing are only allowed only to the extent beyond the increase in the property's value. So for instance, the cost of the improvement minus the increase in the property value, medical deduction. All right, so kind of seeing how this is. Amy must use a medically prescribed wheelchair. She has an accessibility ramp added to her house. It costs $3,000. The accessibility ramp raises the house market value by $1,100. How much of ramp is allowable medical expense? Okay. So the cost was $3,000 beyond the increase in the property's value. So the increase in the property value should space this a little bit better. Hey, where's my other thing? I'm going to space this better. Okay, cost was $3,000. Increase in property value, $1,100. So the IRS says, look, your house value went up by $1,100. So really, you're only out, what's the difference there? $1,900. So only to the increase beyond the increase in the property value. So the property value goes up, you can only deduct the amount that is up beyond the increase in the property value. And that's a weird way of saying it, but the idea is to say, you didn't really lose this 1,100 that went back into your property. You really already are out this much. Okay, a couple more things down here. Transportation, we talked about this earlier. You can write off 20 cents per mile going to and from any place, which and sometimes going to the medical places can be very expensive. So it could be any of the traveling expenses, but you have to go up to the Mayo Clinic or something in Minnesota. It could be hundreds of miles driven. That could really add up as far as what the it is. So it's 20 cents per mile. This is for medical purposes, and you can write that off. You don't have to have any documentation. You don't have to have receipts or anything like that. So if it's 300 miles away, you can deduct the mileage going there and coming back, and you have to show that you have you have these appointments. You made 3 appointments, and that this is how much, how many miles you went. That's it. And for that reason, a lot of times people use the standard. Lodging, $50 a night for each individual. So if you're traveling by yourself, $50. You're traveling, you're taking your child someplace to have medical treatment, $100, 50 for you and 50 for the child. So yeah, and then again, meals are not deductible. And again, if you think about it, whether you're on the traveling or not, you have to have meals. So the meals are not deductible, but the lodging is those limited to $50. And again, that is per person. All right, insurance premium, we kind of talked about this already, and that is insurance premiums are deductible, basically, as long as you come out of pocket. This includes when you get supplemental coverage. So I have supplemental coverages for Medicare, B, and so forth. Insurance payments withheld from a paycheck are not deductible if the payments are for Medicare or employer reimbursed premiums. So basically, if someone else is paying it, you can't write it off. And if they're deducted from your paycheck for, what was basically the FICA, thing, also that is, you can't write those off. That's the thing that everybody pays, and that is deducted on your behalf, basically. Okay. No, premiums for long-term care are deductible subject to dollar limitations. Long-term care is, these are policies that they almost quit writing them. They really popular about 10, 15 years ago. These are when people have go into a long-term care, like going to a retirement home. And what people don't realize is if they had this insurance, they went into the retirement homes much earlier. because the retirement homes are kind of like a hotel. They do everything for you. So if you have this, you might stay in your house for 10 years, but if you have these things, people jump right into the retirement homes and then just went on vacations and everything else. And so the amount that the companies paid out was skyrocketed. But anyway, these are the amounts that are deductible for that. So if you are if you're 35 years old, then you paid $500. The most you can deduct is $420. The other 80 you can't deduct. So whatever the premiums are, they're deductible, but they're subject to these limitations. And you'll notice that these, they go up as people get into retirement age, because it becomes more and more likely they're going to use them. Oh, excuse me. Okay. In the event that the long-term insurance contracts pays periodic payments to the individual who is chronically ill, any amount in excess of the per diem limit is taxable. Per diem is just the per day. I'm not sure why. It's one of those things I'm not sure why we, everything is per diem, which anyway. One of those strange things is if you're in business, they always talk about per diem, per day, but and the per diem day rate is $370, which is quite a bit. So anything more than $370 per day is it's going to be taxable. So more than 370 a day is taxable. And again, 370 a day though is quite a bit. Whatever that is. You're talking about $135,000. So, if somebody is making, if they have this contract that pays more than $135,000, they have to pick up whatever in excess of that. It's actually $135,000. They have to pick up the excess over that. Okay. Question, anything? All right, and I'll send out